Hi, this is Kirubakaran Rajendran. Welcome to another video with Groww. So, with respect to trading, even though most people go after trading strategies, when to enter, when to exit, and everything, there is one more important pillar which is really needed to become a successful trader is position sizing. So, what does position sizing really does with respect to trading? How it can really help in trading? That is what we are gonna see in this video. Every trader would have done this, like they would have bought some stock with whatever the capital they have, and if the stock goes down 20% or 30% or even 50%, they lose 50% of the capital in that trade. So most people do not really know how much is too much. They do not know what is the right number of shares they need to buy, what is the right quantity they need to buy. So how one can decide what is the right quantity? So people who's following with a position sizing rules and people who do not follow a position size rules. How do we differentiate it? Let's look that with an example. So let's consider this specific share, which is Adani Total Gas. So until December, almost till January 2023, it was trading around 3,800 or 3,900 levels. But post January 2023, it started going down, and eventually it lost more than 82% in this year so far. So, as an investor who have traded in this share, like if you have bought this share at 3,800 or 3,900, you would be sitting at a loss of 82%. So, everybody it is same, whether a guy who's bought with 10 lakhs capital or a guy who bought with 1 lakh capital or a guy who bought with 50,000 capital, for everyone 82% is the total loss, right? So, let us see two different example here. If someone followed a position sizing rules in this specific trade, what would be his loss? If someone do not follow a position sizing rules, what would be his loss? That is what we are going to see now. So let's take this example where my capital is around 10 lakhs. Okay, so we have this Adani share price. Consider we would have entered around 3,800 rupees. And most people, how do they calculate what is the total number of shares they need to buy? Is they just simply divide their capital by share price. Like if the share price is 3,800, they just say, okay, my capital is 10 lakhs. Let me buy 10 lakhs worth of shares. So they simply buy whatever the based on entry price or based on share price, they calculate that. And based on that, if we see if someone is having 10 lakhs capital, at the max, considering 3,800 rupees as entry price, he can buy 263 shares. So now the share price is down 82%. So with current LTP, his total loss is approximately around 8.3 lakhs approximately. So which is 83% he has lost. So now same trade, if someone else has taken, say with respect to same 10 lakhs capital, same entry price, but instead of buying full shares, he decided that I wanted to risk only 20%. So I do not wanted to risk more than 20% of my capital. So I wanted to risk only 20%. So if he is risking 20%, then what is the actual amount is 2 lakhs, right? So 2 lakhs is the amount which he is willing to risk in this trade. So now what he'll do is, I wanted to risk only 20% of my overall capital. So what he'll do is calculate what is 20% of 10 lakhs, which is 2 lakhs. So out of 2 lakhs only, he'll buy this shares, which comes around only 53 shares. So same, he'll buy 53 shares. Now LTP is 655. So even though Adani share is down 82%, from his overall capital is down only around 16.5%, which is around just 17%. So the first guy did not follow a position sizing rule. He put all his capital in this trade and ended up losing 8.2 lakhs or 82% of overall capital. But whereas the other guy, he decided that he doesn't want to risk more than 20% of his capital in one trade. So due to which he bought only 53 shares. So how did you get 53? Is nothing but you first calculate what is 20% of your capital, which is 2 lakhs. So this 2 lakhs divided by entry price gives you number of shares, which is 53. So using that rule, even though the stock is down 82%, he has lost only 1.6 lakhs, which is just around 16% or 17%. That's all. So this is how position sizing plays a vital role when you're taking a trading decisions. Without following that, you could lose a huge amount of money when market goes against you. But following this rule, you can easily control the risk to a greater extent. So now let's see how you can decide what is the total number of shares that you can buy based on stop loss. See what happens is, most number of people, they know exactly where the stop loss is going to be when they take a trade. So suppose they see, okay, a particular stock is breaking out and moving up. So from 100 rupees, it's gone to 150 rupees. So now they'll try to enter at 150 rupees and they'll keep a stop loss, 10 points, 20 points or 30 rupees below that. So if they are entering at 150, maybe they keep a stop loss of 20 rupees. So by if it goes to 130, they'll exit it. So people precisely decide, okay, this is my entry, this is my stop loss. But is there any specific rule which can tell them this is the total number of shares they can buy based on stop loss? So that is what we are going to see now. So let's consider the same Adani share. Okay, so not every people would have hold on to the share till it goes down 80%. Some people would have used a stop loss, right? So consider someone is entering into a trade around 3,800 levels, and they are keeping, okay, if it goes and breaks the 3000 level, which is the kind of a support level. So if someone decides that if it breaks 3000, I will exit from the trade. So they are entering at 3800 here, and this is the support zone. So if this zone is broken, they are going to exit it. So they're keeping 3000 rupees as a stop loss. So now what would be happening, say suppose if someone deployed all his capital in that trade, or if someone followed a position sizing rules here, knowing this is a stop loss. So what would be the overall outcome looks like? Let us see that. So let's consider these information. So the same, your capital is 10 lakhs. So you're not following any position sizing rules here. So entry price is 3,800 rupees. Your stop loss, as I said earlier, it is 3,000 levels. So your overall risk per trade is 800 rupees. Your entry price minus your stop loss gives you risk. So similarly, you are buying the number of shares, which is 263. It is simply divided by your capital divided by entry price gives you the number of shares, which is 263 number of shares. So you are buying that. So if stop loss is hit, where when the market goes down and comes to 3,000, you are exiting it. So you are facing a loss of 2,10,526, which is approximately 21% of your overall capital is lost when the stop loss is hit. So now consider a position sizing rules here, where you are saying that I don't want to risk more than 5% of my capital in this trade. So your 5% of capital is what? Is this 10 lakhs into 5%, which is 50,000. So that is your overall risk that you wanted to take in this trade. So no matter what, when the stop loss is hit, I do not want to lose more than 50,000 rupees from that capital of 10 lakhs. I do not want to lose more than 50,000 rupees in this trade. So now what will be the number of shares that I can buy? So what you have to do is just divide this 50,000 by the risk, which is 800 rupees. So when you do that, then you get 63. So all you have to do is divide this risk capital by the risk per trade, which is going to give you 62.5. So by rounding it off, you are getting 63 shares. So now you are buying 63 shares at 3,800 rupees. Now when it comes to stop loss, your stop loss is hit, then you are going to lose only 50,000. So in both the cases, your stop loss is same. Both the traders, consider one guy is trading with position sizing, other guy is not following position sizing. Then in the first case, even the stop loss is hit, he has lost 21%, whereas the other guy has lost only 5% of his overall capital by following the position sizing rules. So this is how it can really help in order to control your overall risk. So whether it is stop loss based system or not stop loss based system, when you really know how much you're going to risk from your overall capital, you can easily calculate the number of shares that you can buy in that specific trade. So one more thing, people who trade with stocks, that is what the example is. If someone's trading with options, so what would be their overall position sizing should be? Because there are people who trade in options with 2 lakhs capital per trade, per lot. Some people trade with 1 lakh. Some people buy OTM options as an hedge to trade with just 50,000 or 60,000 rupees per lot. So what is the ideal capital that one should trade with if someone is trading in options? So let's see that. So consider this table. And what your first row you're saying is options premium. So at the money options premium, what would have been the at the money options premium on Monday to Friday basis for Bank Nifty? So consider at the start of the expiry, at the money option could be trading around 500 rupees on the call side or on the put side. So Monday it could be 400, Tuesday it could be 300, Wednesday it could be 200, and Thursday it could be 150, because at the start of the expiry, premiums will be higher. As the days go on and comes near the expiry, premium goes down, right? So now consider you are doing a short straddle strategy, with a 25% stop loss, where you're shorting call option and then put option on the both the side and using 25% stop loss on the individual leg. So if the stop loss is hit on Monday, then out of 400 rupees option premium, if stop loss is hit 25%, then you're losing 100 points as a premium. So likewise, every day it is calculated. So your risk per trade is nothing but multiply these points into the lot size. Bank Nifty lot size is 15. So if one side stop loss is hit with the 25% stop loss, you're losing 1500 rupees. So likewise, you calculate for Monday, Tuesday, Wednesday, Thursday, Friday, and all days. So usually higher the premium, higher the loss. So this is one side stop loss. If C stop loss is getting hit or P stop loss is getting hit, one side stop loss is getting hit, this is the loss. If both the side stop loss is getting hit on a short straddle, both call option and put option, this is the loss that you would face. So with 10 lakhs capital, approximately 90,000 is the required margin, or 190,000 to 1 lakh is the required margin to short one lot with Bank Nifty. So with 10 lakhs, I can trade with 10 lots. So in this case, let us see what would be happening if in case my stop loss is hit on both the sides on all days, Monday to Friday, for a complete 5 days. Then on Monday, if my stop loss is hit on both the sides for 10 lots, I'm losing 30,000 rupees. On Tuesday, I'm losing 22,500 rupees if both the sides stop loss is hit. Wednesday it is 15,000, Thursday it is 11,000, and Friday it is 37,000. So on a whole, in 1 week, if both the sides stop loss is hit, I'm losing almost 1.16 lakhs. So one thing that you need to notice is the loss is fluctuating. As you could see, say suppose on Friday, if the market is not going in your favor and stop loss is hit, you're losing 37,000. But whereas if the same market not moving in your favor, if the stop loss is hit on Thursdays, you're losing only 11,000 because option premium is lower. So on a risk per trade, if you calculate, sometimes you're losing 3.75%, sometimes you're losing 3%, sometimes you're losing 1%. So it is not constant. So let us see what would be the ideal number of shares that I can buy in case I do not want to risk more than 2% in one trade. So in this case, out of 10 lakhs capital, 2% is 20,000, right? So all I have to do is, so 2% of my capital, 2% of my capital, which is 10 lakhs. So that is equal to 20,000. So how many number of lots can I buy is nothing but 20,000 divided by risk, the earlier formula which I showed you. So here the risk is 3,000 rupees on Monday. So approximately. So if both the sides stop loss is it, 3,000 is the loss, right? So 20,000 divided by 3 is equal to 6.6. So which is rounding off. If you round it off, it will be 7 lots. So I'm trading with 7 lots. So likewise, based on the risk and based on the risk of your overall capital, which is 2%, I can easily calculate what is the number of lots that I can trade. So accordingly, so earlier version, I'm trading 10 lots every day. Here, if you could see, on Monday, I'm trading 7 lots. Tuesday, I'm trading 9 lots. Wednesday and Thursday, I'm trading with the higher lots because the premiums is lower. On Friday, if you could see, I'm trading only with 5 lots because premiums is higher. So when stop loss is, my loss will be higher. So I'm reducing the position size. I'm reducing the number of lots I'm going to trade. So this way, when the stop loss is hit, as you could see from Monday to Friday, stop loss is hit, I'm losing only 86,000. Whereas here I'm losing more than 1,16,000. So by applying the position sizing rules, I am avoiding this fluctuation of loss on a daily basis. I'm controlling the risk to a greater extent. So this is how you can apply the position sizing rules with options trading. So this is what I wanted to convey. So always remember, position sizing plays a vital role to become a successful trader. So not just trading strategies or just not just being disciplined in a trading system is essential. You should know how much is too much. You should know what should be the ideal risk that you need to take, and accordingly you need to calculate what is the number of shares that you need to buy. So when you apply these rules and then when you take the next trade, definitely you will see a big difference in your overall trading journey. So now in case if you guys have any questions with respect to whatever things I have explained, please post it in the comment section. I'll address it. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.